Hi, this is Doug Skinner from AFS. I appreciate you watching this short video. The banking industry is in the midst of a prolonged slump in commercial lending. So today we wanted to look at some of the reasons for that. We'll also look at some leading indicators of credit risk and talk about what those indicators suggest is in store for the banks throughout the remainder of the year and into next year. Commercial loans continue to contract. C&I loan growth has actually been negative for 6 of the 8 months of the year, and it's been down on average about 1% per month. So if we were to continue at that current pace, commercial loans would actually be down about 15% for the year. This is particularly important because commercial loans are, of course, such a critical driver of bank earnings. Commercial real estate growth has fared a little better, but even that has slowed significantly in recent months as concerns grow about the health of office properties and healthcare facilities. Now, declining growth has been an issue of both supply and demand. Banks have been tightening their underwriting standards really all year, with some certainly accelerating that pace in response to the 3 major bank failures we saw in the spring. And then on the demand side, the Fed's tightening cycle is making the cost of borrowing much more prohibitive. We're also seeing a great deal of liquidity leaving the banking system. Much of it has come in the form of deposits that are moving to higher interest-bearing alternatives being offered by other financial service providers. Now, the significance of this is that it puts further pressure on the ability of banks to extend credit. That's why you're not only seeing new lending activity slowing down, but you're also seeing several banks recently selling loan portfolios to shore up liquidity and also to lower risk-weighted assets. So liquidity is really at a premium right now. But the banks also continue to build reserves to guard against loan losses, which is restricting new loan growth. And while prospects for a soft landing have increased of late, the banks still have to be conservative in the event that credit losses end up being even more than anticipated. The pullback in lending is certainly not limited to any particular region of the country. As you can see from this map, all areas of the country have been affected. All the major regions of the country saw negative growth in August. There were a few outliers where commercial real estate growth was positive, those being the Western Midwest and the Southwest, but rarely do we see such a prolonged period of declining loan growth that affects the entire country. Now, it's reflective of limited risk appetite right now and how the banks are focused on protecting their balance sheets, shoring up their liquidity, and really hoarding capital in expectation that regulatory minimums are going up in the near future. Here's an illustration of commercial loan performance where we track the percentage of commercial loans that are 1, 2, or 3 or more payments past due. And while the month-to-month numbers are far more volatile than they used to be, by and large, they continue to stay in a very manageable range and near historical lows. Now, there is some noise in this data in the sense that the government and the regulators have implemented a number of measures over the last few years designed to help banks and borrowers navigate through a difficult period. For example, allowing a more liberal use of loan modifications is one example, and that does, though, have the potential to mask underlying problems. But now also that interest rates have increased as much as they have, these are trends worth keeping an eye on. Delinquencies have already increased considerably for consumer products, such as auto loans and credit cards. And we also know that corporate bankruptcies are rising at their fastest pace since 2010. Bankruptcy filings were up 17% month over month in August and are actually now double the level they were this time last year. Here's a long-term trend in bank criticized loan levels. The main takeaway here is that criticized loans have increased 8 consecutive months, and they're now back to pre-pandemic levels. The one way we can think about this is that we have moved away from describing the environment as the normalization of credit to an environment of true credit deterioration. Now, another reason these levels are tracked so closely is because there is a high correlation between criticized loan levels and charge-offs. Thank you for your time. Have a good day, and give us a call or send us an email if you have any questions. Goodbye.